Okay, let me just take us a little back in the late 90s and probably the dawn of the millennium. That's in the early part of the year 2000, when some 45 banks were listed as failed banks. And of course, those banks had their licenses revoked by the CBN. We all know the period when we had so many banks, you know, or especially in Lagos and other parts of the country. And of course, the court also issued order that those banks, you know, be closed, declared closed, and the NDIC then appointed as a liquidator, you know, to them. And the issue of failed banks, as we later, you know, discovered, has been pegged on a particular bill which fortunately has been amended, and the president has, of course, signed it into law. That's the Bank and Other Financial Institutions Act 2020. It has been described as a monumental piece of legislation precisely because of what it will do, and that is to enhance the soundness and resilience of the financial system, so that we do not encounter, you know, similar, episodes of the 1990s. And of course, it will also help to sustain the economy and provide a stability base for it. So this morning on Good Morning Nigeria, that will be our focus. But just before we bring in our guests, let's listen to this backgrounder put together by Kunle Adeyeye.
Nigeria's banking and financial sector had undergone many reforms, which are mostly aimed at strengthening it. Major stakeholders have constantly yearned for a review of the laws guiding the financial sector following the 2004 and 2008 financial crises, which revealed deterioration in banks' assets based on excessive risk-taking, as well as reckless credit facilities and other unethical practices. The operations of banks and other financial institutions have been guided by the Act, which was last amended in 1991. With recent developments in global banking practices, it therefore became imperative for it to operate under a professionally and globally acceptable banking system. Consequently, President Muhammadu Buhari on November 13, 2020, assented to the Banks and Other Financial Institutions Act 2020. This replaces the Act, which was last updated in 1991. New components of the Act include limitations to which banks and other financial institutions in Nigeria can engage in businesses. It also empowers the Governor of the Central Bank of Nigeria to impose and review penalties on infractions in the banking sector to the tune of 100 million naira. The 2020 Act also gives room for creation of a special tribunal to enforce and recover eligible loans, including resolutions of loan-related matters. With these benefits and other embedded in the new Act, can it be said with every finality that Nigeria's banking sector is on the path to stability, or does it still need some injections to make it a global brand? Answers to these and many more on Good Morning Nigeria in a moment.
All right, thank you, Kunle, for that background report you have put together for us. So let's quickly introduce our guests that will give us greater understanding of what this act is all about. Seated with us right here in the studio, we have Professor Uche Uwaleke, and he is President, Capital Market Academics of Nigeria, and of course a professor in Nasarawa State University. Thank you very much for joining us.
Thank you very much. Good morning, Nigeria.
And we also have, from our Kaduna studio, we have Professor Yushao Ango. He's Professor of Finance and Entrepreneurship, Kaduna State University. Prof, thank you very much for joining us on Good Morning Nigeria today.
My pleasure. Good morning.
And joining us from Lagos Network Center is Ayodeji Ebo, Senior Economist and Head, Research and Strategy, Greenwich Merchant Bank. Many thanks for joining us.
Morning. Thanks for having me.
Thank you very much. Now, let's get started with this discussion and let's see what justice we can make to it, to the topic that is in the next 1.5 hours. Prof, let's get started with you and then get a clear picture of the Banks and Other Financial Institutions Act 2020. What's there in it? Let the people know. What promise does it hold for them? What is in this act?
It holds a lot of promise, to use your word, for the financial sector and the economy as a whole. It holds a lot of strong promise. Because just as you know, if there is any sector of the economy that requires regulation, that requires to be well regulated, it is the banking sector. Because if something happens to the banking sector, it has a way of permeating through other sectors, and then we'll have a crisis on our hands. The 2008 financial crisis, for example, started from the banking sector. And of course, we know it had ripple effects all across the world, including Nigeria. It's one sector that if something touches it, it's not just the money market that will be affected. It also affects even the capital market. Because as you know, many of our banks today, especially the systemically important ones, are quoted on the stock exchange. So if something happens to the money market, it also affects the capital market. And banks play a major role even in capital market operations and capital market transactions generally. So for me, the BOFIA 2020 was long in coming. It's a welcome development. Of course, it's one act that has now repealed the old one, the BOFIA 1991. And that's because BOFIA 1991 has become more or less obsolete. Has obsolete laws, obsolete provisions. Okay? So what BOFIA 2020 has done, one of the things it has done, is to recognize the developments in the financial, sector, financial space, developments in terms of brought about by technology. Okay, so now the BOFIA 2020 has made provisions for the regulation of fintech companies that are engaged in money market activities in particular. It has also captured microfinance, banks. And more importantly too, it has also put in place stiffer sanctions for infractions. Okay, unlike before when banks, would be too willing to pay fines, to flout a regulation because the fines, were very small. So now the fines, the penalties are now stiffer. And there's even a shift now more to the individuals than to the institution. So when there's an infraction, directors of the banks are now held a lot more accountable. So it forces them to sit up. So it is going to improve the entire financial system, stability. And I also know that some of the provisions there will go a long way in solving a seemingly intractable problem in the banking sector, which is the issue of poor asset quality of banks linked to high non-performing loans. Okay? If you compare us with other jurisdictions, the rate of non-performing loans in Nigeria, is quite high. And that was why at a point in time, the central bank said, if a bank's non-performing loan is above 10%, such a bank would not be allowed to pay, dividends. One of the provisions in that bill that will ensure that non-performing loans, get reduced is, I think, Section 19. Section 19 of the BOFIA 2020, prohibits banks from granting unsecured credit. Okay, an important C in banking. Now, back to theory now. We talk about the 5 C's. Okay, there are even more now of credit. One important one there is collateral. Okay, if you're giving a loan, there must be collateral. So the BOFIA now is prohibiting banks from, giving loans that are not well collateralized. So that will also help to reduce the issue of non-performing loans. The other one is also the one that some say is contentious. You know, the issue of setting up now a credit, a loan recovery tribunal. So the BOFIA 2020 has now put in place a loan recovery tribunal, a credit tribunal, just as we have in the capital market. The capital market will have the investment and securities tribunal. So what that does is to help speedy resolution of disputes in the banking sector. Okay, it was not there originally. Let me also say that I had the privilege of making a presentation during the public hearing, during the National Assembly public hearing. I went there. I made a presentation in my capacity as a member of the academia. So I was given the opportunity to talk, to speak. Okay, so and I spoke. And one of the things I said during the public hearing, which was not originally in the bill that was sent, is this issue of credit tribunal.
Okay.
Yes, I mentioned it. I said the bill you have doesn't have a credit tribunal, and that it would be nice if something like that is included. And I'm happy to know that that was accepted, and that credit tribunal has now been included, because I cited cases of some countries that have credit tribunal. In India, for example, India has a debt recovery tribunal and also a debt recovery appellate tribunal. So that quickens the various disputes you have in the banking sector and aids the recovery of loans. So people say it's a duplication of, that we have the courts are there, we have EFCC and so on, we have the police, then why have a credit tribunal? Okay, the justification for a credit tribunal is the high rate of non-performing loans we have in Nigeria.
But since you are the one that, brought up that issue.
I was one of the people that met, yes.
Yeah,
met that
let me congratulate you for that and having made it part of the bill, part of the act anyway now.
Yes.
Sorry, let me bring in Professor Yushao Angu, Professor of Finance and Entrepreneurship, Kaduna State University. Prof, the Prof here, Professor Uche Walike, has given us some of the merits, in this new act. But I would like for you to, in evaluating the now obsolete, law, that's the BOFI Act 2004, and how it aided or affected banks and financial system. I would also like you to background this for us, and what exactly is the prompt, for the amendment.
If we are looking at the background, we have to look at the banking system from the beginning. If you recall, when banking started, up to 1958, there was no regulation at all. We had an era of zero regulation, and regulation started after 1958, and by 1959 also, when the Central Bank Act was enacted, that was the era of strict regulation, in the banking system. Subsequently, by 1986, when the Structural Adjustment Program came in, so many reforms came in, and those reforms basically were aimed at making as transparent as possible a lot of operations and relaxing a lot of things. For example, before then, banks were made to open branches in rural areas as a government policy. Banks were instructed, by government to lend a certain percentage of their credits, to certain sectors of the economy, highly regulated. After Structural Adjustment Program and the subsequent reforms that came in, including the 1991 BOPIA, a lot of things were relaxed, including the process of licensing of banks and revocation of banks. Now, what has happened, or what is happening with this law, the 2020 law, is that government and the National Assembly itself has seen that there are quite a lot of developments, and there is need to come up with laws to take care of them. Now, a lot of challenges, like Prof said, in the banking sector, a lot of problems that we have had all along were due to non-performing loans, because that is what led to collapse of many banks in history, in this country and everywhere else. So the effort made in this bill to put measures that will reduce some of these incidences is something to look at and say is commendable, and including also the tribunal. Congrats for initiating. What you have done is to show that academics actually can propose solutions to national economies, not only theory. We can also propose solutions to real problems of this country, and I believe quite a number of problems can be resolved that way. Now, much of the Act also, the 2020 Act, brought out a lot of corporate governance issues. Now, a major problem, again, pertaining to non-performing loans, had to do with insider abuse, where some directors of banks, we know that in Nigeria, we had the failed bank tribunal incident during the military regime. We know that a lot of bank directors used to take advantage of depositors' funds and lend to themselves directly or indirectly. This has been strengthened, with BOPIA 2020, whereby a lot of that is limited. That is a major contributor. Another thing that I saw in that law is limiting the what we refer to in bank lending as one obligo limit. One obligo limit is the amount of money you can lend to a person. When we say a person, we are also referring to corporate entities or a group, who are jointly owned by the same persons, limiting it to 20% for commercial banks and 50% of paid-up capital unimpaired by losses. All of those were trying to encourage good governance, corporate governance, that is, in the banking sector. So those are some of the changes that have been brought, among other things. Thank you.
Oh, many thanks, Professor Yushau Ango. There is no doubt that, technology played a very important role in trying to get this bill out, or this act out. And it seems as if the banking sector has been very much concerned about this, and it seems it's going to go a long way in putting across or getting its operations much more improved this time around. Now, Ayodeji Ebo, Senior Economist and Head Research and Strategy, Greenwich Merchant Bank, if I may ask you this, what or how strong has the ICT or technology, factor been in making this act a reality?
Thank you. If I laid some form of background, if we look at the technology space in Nigeria, with the advent of mobile or telecommunication, we have over 80 million users of telephones. If you look at the penetration rate, so it's almost close to about 80 to 85%. So the banks have been able to leverage on that technology. If you recall, those days, online banking was not possible because you need a device for you to be able to action or for you to be able to use those online devices. So the advent or the background of technology has really helped banks to be able to build their system on this, and that has enhanced and has increased transactions within the banking space. You also want to look at the ease of also banking. If you discuss with a lot of the bank customers, most of them, it's been long for most people as have visited the bank. You do all your transfer, you do all your transactions online. Even as significant as statement, you can request for your statement online. So riding on technology, and especially mobile phone, which you look at this new act is also trying to cover the aspect of fintechs, which is also very critical to support financial penetration. So by and large, if you look at the riding on the back of technology, financial inclusion has also improved. Most banks now have what you call USSD code that doesn't ride on internet. So you can transfer money without internet, and you can also receive the code to go and take money from the agency banking. So they've been able to, the banking system has been able to ride on that robust technology. And over time, even if you look at the security of the Nigerian banking systems, that I'm talking about the internet security, you would see that they are stronger than what you even have in some of the developed countries. The authentication, the two-factor authentication that has been introduced, there are some advanced countries that don't even have that on their platform. So that buttresses the fact that our technology system is also very strong. I'm not saying it's perfect, but we have been able to, at least we've started and we've continued to increase on that based on some of the loopholes that we continue to see. That will continue to increase the security system or features that will be introduced in it. So it's critical that technology has to be taken very serious because of the ease of usage and because of how you can also be able to penetrate into the rural area, which is also very critical.
All right, thank you, Ayodeji Ebo. Let's come back now to the studio. Professor Uche Uwalike, this act is meant to address a lot of infractions, in the financial institutions, especially the money deposit banks and other commercial banks. You've talked about the issue of NPLS. You talked about the issue of insider, that's and abuse of corporate governance laws and all that. So, does it? I'd just like you to talk to us about the health status of our banks. What does this imply? How does it? What does this tell us about the health status of our banks?
Well, if we go by what the central bank, tells us, I think the financial system is stable. Our banks are, I would say, stable, largely stable.
Regardless of the whole...
Yes, largely stable in the sense that if you look at the indicators, some performance indicators, including even the non-performing loans, okay, what you find that over time, okay, especially in recent times, it is trending downwards. As I said, there was a time it used to be as high as 14-15%. Okay, so today it is at least below 10%, the non-performing loans. So
as of this year, what I have is 10%.
10%?
Yes, 10%, between 9 and 10%.
Okay, but I know it's below 10%. If you can, you can get that even from the last MPC communique, where the central bank talked about financial, sector indicators. So for the banking sector in general, I would say that is quite, it has improved. And that's why also why we are seeing the numbers, even in their valuation, in their stock market performance. Okay, the banking stocks appear to be performing well, especially the big five. They are performing well, and that goes to show that these banks have, if you like, call it strong fundamentals. They have strong fundamentals. So our banks are relatively strong, especially since
when you talk of strong fundamentals, are you talking about their capital, the liquid capital base? I don't know. Okay, for capital adequacy ratio, again boils down to the indicators I talked about. The the financial sector indicator, for banks. Okay, the capital adequacy ratio, the issue of non-performing loans. Okay, those are issues around prudential issues, and even the BOFIA. The BOFIA also made reference to minimum capital. But when you talk about fundamentals, you are referring to things like the profit, okay, the dividends. Many of them declare the interim dividend. So if you have a company, for example, what does a share? If you're a shareholder, what are your expectations from the company? You want the company to pay you dividend.
So if a bank has good, you know, dividend per share, or dividend yield, okay, or price earnings ratio. So these are things you will call fundamentals, you know, for a company. So, and I think our banking system, okay, you know, has these fundamentals. I also think the BOFIA, okay, the BOFIA 2020 has some provisions that are meant to promote corporate governance. Okay, well, you can talk about some weaknesses in corporate governance, but this BOFIA is now out to strengthen corporate governance in banks. One of such provisions is the provision that requires the central bank now to attend board meetings of the banks.
You know why I asked that question?
Yes.
Because in the course of research, and NBS, I just found out that the NBS is estimating 1.4 trillion naira in terms of NPLS, that's non-performing loans, and which it says it accounts for 9% of all loans in the economy, against CBN prescribed 5% threshold.
Yes, the threshold is 5%.
Yes.
The non-performing loan ratio, yes, is above the threshold, and which is why the central bank is worried about it in the first place. Central bank wants to further bring it down. What I'm saying is that, relatively speaking, relative to where we were before, okay, it would appear that non-performing loans, you know, are coming down. And some of the measures we now have in the BOFIA will further bring it down, possibly to the 5% threshold, you know, by the central bank. I was saying the BOFIA 2020, you know, provides, I think section 39 of it says that the central bank can now attend board meetings of banks. So whenever they're having their board meeting, the central bank should be invited to be in attendance as an observer. And I also think this is in line with international practice, because I know from my little research that in Hong Kong, for example, the Hong Kong Monetary Authority also holds meetings with the board of directors of banks, you know, every year. So what that does is it creates a platform for the bank to communicate firsthand to the banks, you know, its supervisory concerns. So if the central bank has some concerns regarding the whether it's the financial position of a bank, or its risk management process, or its internal control system, which we expect the auditors to even report on. So if there are concerns on the part of the central bank, those concerns can be made known to the banks during such meetings. Although our own talks about attending as an observer, but I would have preferred a situation where it would be a case of the type we have in Hong Kong, where the central bank meets them, you know, the board of directors, you know, every year. Because if you attend as an observer, there's a limit to the kinds of contributions, you know, input that you can make. So by and large, as I said, the BOFIA has good provisions to strengthen corporate governance, to even also prevent money laundering and the likes. For example, there is a provision there that restricts our banks here, okay, from entering into relationship with certain entities abroad. Mm-hmm. There are certain entities you're not expected to enter into relations with, okay, especially if those entities are not incorporated in those countries, or don't have affiliations to, you know, companies incorporated in those countries. So that's, of course, promotes regulation, because if you're a company in another country, or a bank in another country, and you're not incorporated in that country, okay, you know, you can do anything and easily get away with it, as long as you're not being regulated. So the BOFIA now says you don't have to enter into any relationship with any foreign entity that is not incorporated. You know, it's just like saying don't enter into relationship with any company that doesn't have a face in that other country. So to me, that's also a very good provision.
Is that what you call shell banking?
Yeah, no, that...
okay, because I also learned that this act, you know, it's also to deal with that. So I would maybe...
Before we get down to that,
shell banking.
it so seems as if the BOFIA 2020, you know, will to a great extent limit money laundering.
Yes.
And of course improve good governance, as you said.
Good governance, yes.
And of course there's going to be stricter measures for, you know, those who take NPLS and misuse it per se.
Beautiful, yes.
We'll get back to that later. Let me get to Professor Ango. And then see, looking at the BOFI Act, it is expected to increase the appetite of banks, Prof. That's to channel credit to the real sector to support economic recovery and then also promote growth. Do you see that really happening in the nearest future, given the strength of the BOFI Act?
Well, in terms of sectoral allocation of credit, what we have seen of recent is that banks are moving more or less to safer areas, what they assume is safe. And so by that, they are hardly investing in areas that will stimulate growth, except where, for example, some interventions are done and they are just on lending, like central bank intervention or Bank of Industry or Bank of Agri is intervening somehow. The major sectors of the economy where we need huge credit to support it does not get those credits. What happens in reality is that banks are moving at two extremes. One, they go to the highest, which is the highest sectors, for example, the oil sector, the communication sector, and lend hugely there. And then they also lend to the, what we call the consumer market, which is the lower end, salaried employees, because they are sure the money will come. Not lending in between, that is in the middle, manufacturing sector, and agri sector, mining sector, those sectors that need to be lent to, you know. Now, the law will not go to the extent and has not gone to the extent of directing banks to lend. They must lend to certain sectors, because if that law, if it does that, it will go back to what we referred to earlier as the era of strict regulation. But I think, you know, given the realities of the times, you know, the banks have to find a way of investing in the real sector. And also not only the top end of the sector, the lower end of the sector. And like Prof said, he mentioned the fact that one of the C's was collateral. Another C is, of course, apart from capacity, there's also the C of character, I know. And there are many measures now that have been taking place that are there in terms of rating agencies and all that can actually rate some potential borrowers. So what I'm trying to say basically is that while the central bank through various means is trying to encourage them to lend to the real sector, the central bank may not necessarily direct them that they must lend so to these sectors. But a lot of measures are brought in terms of interventions, and sometimes they just act as on-lenders to the real sector. I think given the teeming population we have, and especially youth population, there is need for the banks to consider safe areas of lending to the real sector of the economy, not just moving in one way. I think last year or the year before, we have had cases where banks had, some 2 years, 3 years ago, when a lot of importers of petroleum were there, and there was subsidy. Many of them just moved and lent to that sector hugely, you know, in trillions of naira. Now, resulting in when that was stopped, and some of them could not pay them on time, that led to a huge volume of somehow non-performing loans. So basically, they don't need to move, you know, with just one side of the, whatever side they think, you know, will do well. They need to spread their risks. That is also necessary for the bank. So I will urge them to actually lend to the real sectors, you know, in line with the strategic objective of the country, which is to ensure that economic growth.
Okay, thank you. Ayodeji Ebo is in the Lagos Network Center, and my question is to you. I just read something out from the NBS. That's its 2019 June report, indicating, of course, the percentage of non-performing loans, you know, that are out there. I'm sure you must have looked at the details of this act. What are the specific provisions that are directed to addressing this infraction?
Thank you. I think looking at the non-performing loan, if I'll also speak to that, CBN has also been very proactive, because if you look at this era, the era of or this year of COVID-19, banks' non-performing loan should have risen to as high as 30–40%. But CBN announced, as part of the palliative from the monetary angle, to grant forbearances. And at the last one of the MPC meetings, we saw that over 50% of the current loans have applied for forbearances. What that means is that they would have, CBN allows those banks to restructure most of these loans. So we're all aware it's a systemic problem, that we know that COVID-19 has affected a lot of businesses. A lot of schools could not open. A lot of companies had to shut down. So as a result of that, CBN gave them that leeway to restructure those loans. And that would be one of the areas or options that may be on the table, is to increase the tenor of some of these loans, also to reduce the rate at which they also service it. Some of them may even give some form of moratorium, giving them a break, and giving them that opportunity that when business pick up after a certain period, then you can resume the servicing and the pay down of the loan. It's true, the non-performing loan is, when you look at it, an average of about 10%, but there are also some outliers. If you look at the top banks, you would see that for most of the top banks have less than 5% NPL. And what most of the banks are strengthening their risk management system. But what we're also noticing, what we've noticed within the system, is for most of the banks, they all focus on existing sector, all focus on existing loans. So you see what you say as price cutting. So you refinance existing good loans at a lower rate. So most banks are not willing to take that risk, while I also understand, because they also need to preserve shareholders' funds. Most banks will also need to develop capacity. They need to be known for a certain sector. So you develop that capacity, have a niche for yourself, develop that capacity in those areas. Do you want to focus more on the SMEs? Over time, yes, at the beginning you may lose money, but over time you would understand the cash flow of that sector. You understand all the inherent risk within that space, because it's very obvious that some of this risk will not go away. And that is why when you continue to see that premium that banks will charge when they are lending to some of those very perceived risky sector, maximum lending rates is still around 29% compared to the prime lending rate. Prime lending rate is the rate that you lend to the blue chips company. That has gone down, has moderated to around 9% from about 11% about 3 or 4 months ago, due to the lower fixed income rate environment. So focusing on the non-performing loan, I believe that with what has kept it this low is the forbearances that CBN has also given for most of the banks to restructure. But the implication of that would also be on interest income. So if you have restructured a loan and you have given some form of moratorium, or the interest that should be paid, you have reduced the amount of interest that should be paid at this particular time now, or you've also increased the tenor of the loan, it means that the interest income that you would get from that loan in the interim would be lower. But interestingly, when you look at we're expecting the third quarter result of most of the banks within the next 1 week. And what some of the major areas that would see that would have covered up for some of these revenue gap would be that gains from investment securities. So when you look at the yield environment, bonds were as high as 11–12% this year, and currently for the longer end of the curve, it's trading around the 7% level. So when you look at the spread that you get, the capital gain, so for most of the banks, you would see them making significant income from that area. Another area where is also benefiting for some of the banks, for banks that are long in terms of dollar assets, the adjustment of the naira has also favored them within that area. So by and large, I believe that the non-performing loan would be kept within the necessary levels. That particular act, that which part of what Professor Waleke suggested, that the credit tribunal, I think it's really I totally agree with that, so that it's very specific. You won't have to model up with other cases, and it would also increase the time, or reduce the time that judgment will be given. So you won't have to most of these judgment elongated, because some of the things that are discouraging the banks, even if you have the collateral, someone has given you his or her house as collateral, by the time, because they know the system of how our courts can elongate things, can push things forward, you may be you may not be able to realize that asset to cover that non-performing loan because of the time it's taking. And as a result, you will need to make full provision, 100% provision for that particular loan. But now, if it's what we would be expecting is to see details of how long any case should go before it's finalized. You know, when you look at the election, how our electoral system is, you know that there's a certain number of days that election petitions or cases should be concluded. That is what we'll be looking forward to. Part of what would also, that I think that should also be looked at, even if it can't be included in BOFIANA, is having a credit system. So when you look at the developed economies, you have people try to work towards earning a good credit rating system such that it attracts a certain interest rate. So if, for instance, my credit rating based on a scale of 1 to 10 is around 8, it may entitle me to an interest rate of about 15%. And if someone's credit rating is around 5, maybe the interest rate is around 22%. So you would see instances where even for those that may not require the loan now, they try to borrow and try to pay back to increase their credit rating. And as a result, you would see over time, people will want to repay back those loans to have a good credit rating, and it would also minimize the concern of the banks because they need to protect shareholders' funds, and they don't want to lose out these funds. So if you see a lot of people achieving that high credit rating, and over time, when people work towards that, if you know you default and that bans you almost for life from accessing loan, or you need to pay a significant premium for you to even be able to borrow.
Ayodeji, thank you very much for those insights. Let me just come back to the studio here and then get the insight of Professor Uche Owaleke on this, the tribunal issue. Banks, when we talk about the tribunal, what comes to mind is default and some infractions, either on the part of the bank or the consumer or the customer. Credits are there, loans are there, so the interaction continues between the banks and the customers and the consumers of banking services and the rest of them. What is BOFI saying about, or how strong is the tribunal aspect of BOFI in trying to check this so much so that it can make the bank stronger and give more confidence to the customer?
Yeah, thank you. Just as I said earlier on, we have lessons to learn from other climes. In India, I keep using India as an example.
Why do you always want to refer to
because
India?
Studies in India have shown that the establishment of the debt recovery by banks and other financial institutions Act of 1993 in India, studies have shown that has helped in reducing this issue of non-performing loans.
Okay.
Yes, in India. And that's why, apart from having the debt Recovery Tribunal. I also said there is also the Debt Recovery Appellate Tribunal,
Okay,
like the
two
appellate
levels
court.
now.
Yes,
Right.
yes, in India. So back home, I think strongly that the Credit Tribunal will serve the same purpose, because what it does will be to, as I said, hasten the adjudication process. Okay, if there is dispute, you take it to the tribunal. Quick dispensation of justice. We know the issue that we have with our courts, which is part of why we have this AMCOM. If we had this credit tribunal before now, maybe the issue of huge non-performing loans, or toxic assets wouldn't have been there, and maybe we wouldn't have been talking about AMCOM. Today, AMCOM has over 5 trillion naira outstanding debts to recover. And that is why anytime we talk about Nigeria's debt, I always include the AMCOM 5 trillion, because that contingent liability, in my view, is likely to crystallize. And once it crystallizes, it becomes the debt of the federal government. So that 5 trillion naira is huge. And part of why we have it is because we didn't have a mechanism like this, to quickly resolve this thing and get this money from those who are owing the banks. So you are talking about what strengthens part of the what strengthens the credit tribunal. Okay, I think the fact that the BOFIA also provides that the president of the tribunal, enjoys immunity. So once a tribunal has given a judgment, the president has taken an action, you can't now come to sue the president of the tribunal. So it also reinforces, that tribunal. And as I said, in the capital market, we have an equivalent. We have the Investment and Securities Tribunal. So those who say it's a duplication, we have EFCC, we have the courts. Why also have this? What about are they saying the IST in the capital market is of no relevance? Okay, so I think the tribunal is quite good. But there are concerns. The concern I've read about it, came from the National Economic Summit Group. Okay, of course the NSEG supports it, but they're only saying that the fee, okay, the case fee, if you're applying for a case, okay, the case fee of 0.5% of the claim you're making, that is quite high, that the government should look into it. That is, I think that's the angle of the NSEG. But NSEG supports the issue of having a credit tribunal. The other provision there that I also think will help reduce the issue of non-performing loans, I also mentioned it earlier, is Section 19 of BOFIA. Section 19 of BOFIA 2020 prohibits banks from granting, unsecured credit. And there is also the section that talks about single obligor limits. Single obligor limit, max of 20% of shareholders' funds. Shareholders' funds comprise share capital and reserves. These are what make up shareholders' funds. So 20% of shareholders' funds unimpaired by losses, okay? You don't have to be exposed, more than that. So I think the implementation of that, because we know the issue of non-performing loans, especially when it comes to insiders, directors, okay, banks tend to flout that. Banks tend to give them loans, in excess of what is provided. And there is also the issue of over-concentration. You see banks concentrating their credit, to a particular sector, especially high-risk sectors. Part of why we're having many banks are having problems today with the collapse in oil price is because of overexposure to the oil sector, giving loans to the oil sector. So I think generally the BOFIA 2020 will again, strengthen financial systems and stability. I also talked about the issue of the central bank being part of the banks, attending their meetings.
I would really like for you, maybe when we come back to you, because in all of this, we want to know the specific monetary provisions from BOFIA, as of course as a punishment for offenders, and there may be the regulatory powers of the NDIC and the CBN in all of this, and how of course this will now help to sanitize the industry.
Yes,
But
I will also want to touch on
Yes.
some aspects of the bill that I would also want to
The
see.
act, you mean?
Yes, the act now that I will also, maybe in future, I will also want to see amended.
Yes,
And some of those concerns have also been expressed by the Nigerian Economic Summit Group.
Okay.
I want to mention, a few of them.
Okay, so when we come back to Abuja, let's bring in Professor Ango. Prof, Professor Owaleke here is always going to India, but let me also take you to China. Where research has also shown that some decades ago, of course, they also experienced some of the financial recessions, but they perfected their strategy of debt recovery by making the asset management companies more efficient and proactive and proactive. We have our own asset management company here, and I want for you to tell us, is this tribunal, is it, for want of words, a collateral, for debt recovery? Is it efficient? Is it that all we need? My directors are telling us to go for a short break. So please keep the questions. When we come back, you'll give us your response. This is Good Morning Nigeria. Let's take a quick short break. When we come back, we'll now go over to Professor Ango. All right, welcome back. And our focus this morning is on the Banks and Other Financial Institutions Act 2020, just assented to by Mr. President. So let's go over to Kaduna studio where Professor Yushao Ango is. Professor Ango, I asked a question. I said in China, decades ago, they strengthened their debt recovery strategy by, of course, making their asset management companies better positioned, more proactive, and more efficient. We have Amcon company here, asset management company here. What is, how can we make it more effective? Will the tribunal be a sort of a buffer for it?
Absolutely. The Amcon will find the tribunal very useful. They have quite a number of cases that they will rather take, because some of the Amcon activities involve going to courts actually sometimes to recover some of these huge amounts. So they will find it very useful. But it should be noted that even Amcon itself, Amcon or Amcon-related or Amcon-like kind of institutions are all over, in, like you said, China, India, Malaysia, Turkey. Many countries have had similar, if you like, institutions all trying to collect the bad debts, so as to make the books of the banks cleaner, for more unimpaired, if you like, transactions. Now, they will find this tribunal very, very useful. But Amcon itself has a time limit. I read somewhere where they said by 2023, Amcon will not be there. In the provisions of the Act, there was provision for some monies to be set aside annually, as a buffer, to take cognizance or care of some of these bad debts. And that will be contributed somewhat by the CBN and the other deposit-taking agencies. So I believe this, having this tribunal will help Amcon very well to recover. But I learned there is a time limit for Amcon, so that means probably we are likely going to see some other structure that will come up to replace Amcon or give it a new life, as it were. But I believe more than anybody, the Amcon will find this tribunal very useful.
Well, Professor Ango, thank you so much. Let's get down to Ayodeji Ebo in Lagos and then hear from him about, the public fear or the real sector fear about why banks seem not to be heading towards their direction. Although there are interventions here and there from so many sectors into the real sector, but the BOFI Act 2020 seemed to encourage the banks to do that so that the economy can grow fast, really. Are the fears you express at the real sector, talking about the C's you mentioned, collateral, for instance, capacity and character? The capacity and character, you do have them, really. But the collateral thing seemed to be behind the fear. I mean, is that fear really founded?
Yeah, interesting. I think we should first recognize that for the banks, um, they are private sector led, and they also have that responsibility to protect the shareholders' fund. So, while I agree that in terms of their risk level can be improved on, but the first thing that would need to note that some of these perceived risk are still very inherent. So when you look at the system, so you look at for the average SME that wants to even borrow funds, are they competitive? So you look at our infrastructure system, they will need to provide their power, they need to provide a lot of their resources, even the distribution of their goods will come at a higher cost. As a result of that, they are always out of work. So when you do the visibility studies, you would discover that the margin that they will make would almost not be there, would be very thin, and any major shock can throw them out of balance. So for the banks, they are always very careful about that, because when you look at, we are comparing, if you are selling now that the after will be enforced from January, are these companies going to be very competitive? When you need to, by the time you had that cost of other amenities that government should provide for you or should support you with, then your products will not be very competitive, and you may not be able to recover the loans that you have collected. So for the banks, that's one side, that's one view, one side that I think we should also look at. But on the other side, we may also want to look at them. They need to begin to change focus. So when you look at what is currently happening, in the last 1 year or 2 years, interest rate on risk-free investments was as high as 18% when you look at the effective yield and you adjust for tax. No reasonable business person or would want to go and lend at 30% when you can get a risk-free investment at 18%. Now, if we look at the current situation, 364-day treasury bills is as low as 0.3%. Now, for most banks, would be forced to begin to change their mindset. So you can test the waters and say you are setting a particular amount to see how you want to grow that particular sector. There's one of the banks that you can see that they focused a lot on the agri sector. They are growing big within that space. Over time, they would master that particular sector, and that would help them minimize the risk, improve on their risk framework, and that would impact as we progress into the risk sector. So what my view is that most banks should carve a niche for themselves. Look at, do you want to go into the health sector? Do you want to go into the education sector, construction sector? Try and master that sector to minimize that risk. That risk would have to live with it. So the collateral that we're trying to solve, there's this collateral registry that was set up, and that allowed movable assets to be registered. While I may not be able to say how effective that has been, but with also the credit tribunal, it means that cases can also be brought to a close immediately. Looking at how the structure of the banking system is now, it's also with that credit bureau system that have also been set up, you can see your credit history over time. I've personally, on my own, I've gone there to pay online and check my credit history. I was able to see all the history of some of the credit I've accessed in the past and how those payments have been made. So I think would evolve over time that banks will begin to change their focus. Now, the loan-to-deposit ratio policy of the CBN is also pushing the banks to look at lending by all means. No, the treasury bills environment is becoming a zero-yield environment, so there's no easy money on the table for the banks. Now would be the focus to shift into loans. We saw before pre-COVID, personal loans has been increasing, so they have been giving uncollateralized loans to even SMEs. You see, they profile your account based on the algorithm, and they are able to profile the account and let you know the available credit that based on the transactions on your account that you can easily access. We believe that once the coast is clearer now and there's some form of stability in the economy, we'll begin to also see that. We've seen mortgage rates have also, there are banks that have reduced that mortgage rate significantly.
All right, Ayodeji, thank you. Well, we all know that with the use of our smartphones, we can almost transact our financial businesses, from anywhere in the world or anywhere in the country, provided, as Professor Uche Waleke would say, you have the fundamental, which is, of course, connectivity. But there is also a percentage of people who are not ICT compliant and who would also require, to go to the bank, to conduct their own transactions. Now, the BOFI Act 2020 prohibits banks from opening what I would say indiscriminate opening of branches here and there, and all that, or what you would call rural banking. Professor Waleke, the banks are kicking against it.
Well, I would say banking is evolving. And unlike what we used to have, it's going beyond the issue of brick and mortar. Okay, even the banks themselves recognize that the future is in having fewer branches. Okay, and with the advent of agency banking, the central bank has been promoting agency banking. So that has, if you like, is now filling that gap. Okay, so a bank doesn't need to have branches.
Physical.
Yes,
presence.
physical presence. Structures. Okay, all over the country. Okay, what the bank requires is to, have agents, commission agents that can be in those rural areas, attending to, the people. For one, of course, it reduces cost. Part of why you find interest rates.
But the license will now specify your area of operation.
The license has always done that. The license would say if you're a national bank, for example, you
have a wide spread,
exactly.
national spread.
Yes, if you're a regional bank, you're restricted within a particular, region. The license will, specify that. So what I'm saying is that going forward, okay, a bank doesn't necessarily have to have physical, because as I said, it increases even their cost of operations. And this cost of operations, they have a way of shifting them, to their customers, by way of higher lending rates, higher charges.
But this agency or agent, or I don't know what you call it,
yes.
banking.
Yes.
How reliable is it? Do the people have the people developed confidence, in having a transaction with such a scheme? Yes,
it's going to, of course, it's a gradual thing with increased awareness. I'm sure the level of acceptance.
I mean, because if you come to me as an agent, yes. I'll have to verify, your identity, verify, or do other ground checks, before I transact.
But that's not a problem. I said these are licensed agents. Yes, and they will help you with your, basic banking transactions. So I was making a point, if you permit me. Yes, the point has also been made that banks are, more like private sector institutions, and just like any other, private business, the objective, banks are there to make profit. And the objective, as we say in finance, is to maximize shareholders' wealth. So they want to maximize their shareholders' wealth, okay, which is why a lot of banks will find it difficult lending to the real sector because of the high risk, okay. Banks will prefer to do business that will quickly give them money as profit-oriented businesses. So that is why most of the time the central bank is only left with the moral suasion tool to encourage them to lend to the real sector. So the way lending to the real sector will be more effective, especially against the backdrop of infrastructure deficit. Part of why banks have difficult lending to the real sector is because if you lend to a businessman, the small business person, has challenges of infrastructure, for example, and he may not, the entrepreneur may not be able to even repay the loan. So the issue of infrastructure is there, okay, except we address this infrastructure bottlenecks. It may be difficult for banks to say they're lending to the real sector, and that is why the central bank came up with the idea of NISA. So the central bank can provide a guarantee, especially with respect to lending to the agri sector. There is NISRA, to guarantee that such loans, will come back whenever they are given out. The other issue I want to point out are issues to do with the bill, which, in my view, okay, it deserves issues that deserve a second look. One of them is Section 3, subsection 3 of the Bofia bill, okay, that says the central bank governor, has a right to refuse granting a license, a banking license, without giving any reason. Okay, so that to me should be looked into. Section 3, subsection 3 of the Bofia bill.
And there's a concern there.
Yes, the concern. When you refuse a license.
I thought the new act says the CBN should provide explanation for either refusing or accepting.
Oh, okay, the one I saw.
Okay.
The one I saw, Section 3.3 is saying, no. So if it has been taken care of, that.
Yes. I thought in the recite it says the CBN, has to give a reason,
yes,
for either accepting or rejecting a application for a license.
That makes a lot of sense. And there is also the issue of jurisdiction. Some sections too that define the business of banking. Okay, that definition is quite is so generic, such that it even encroaches. It tends to encroach into things that are ordinarily regulated by the Securities and Exchange Commission. So there are certain aspects of the Act that appear to be in conflict with CAMA and the Investment and Securities Act of 2007. Okay, that of CAMA, for example, I think one of the sections there, talks about mergers and reconstructions. Okay, banks, mergers and reconstructions. That if a bank wants to undertake a reconstruction, or two banks want to merge, that the banks themselves can initiate the meeting and take the decisions. Whereas CAMA says it has to be a court-ordered process. So the Federal High Court, usually supervises, that kind of thing, in order to protect the shareholders. So that should be looked into.
Prof, we have a lot of tweets here, and there are questions that have been asked by the viewers. So I think we'll just take some of them. And gentlemen, I'll advise you just, if you have your pens, there are a number of questions that have come in. Let me take this one. Dele Jack Solomon says the Bofia Act 2020 will strengthen the regulatory and supervisory framework for the financial industry indeed, and provide additional tools for managing failing institutions and systemic distress to preserve financial stability, among others. He said effective engagement of stakeholders is needed.
Low Alpha says whatever is the Act all about, it should address the merit of deductions from commercial banks at will, that is, and also aim at repositioning them for efficient service delivery.
So the first question will be commercial deductions from commercial banks. You know, does the Buffy Act 2020 address such? So Mutana Farouk, financial institutions in Nigeria need to be strengthened in terms of financial and other dealings that have direct bearing on financing micro, small, and medium enterprises, that is MSMEs, at a single-digit rate interest. This can help to boost the Nigerian economy internally.
We've been talking about that, the real sector here now. And Suleiman Babagana says it will bring sanity to the sector, and that's the Buffy Act, and then attract foreign direct investment, thereby boosting the economy of the country.
Okay, Nandok Wiyeb says, I think there's a lot the CBN needs to look into, like cutting on certain bank charges and ensuring a friendlier customer service, which should keep us smiling to the bank. If you keep pinching my savings, how much will be left for me? We deserve to breathe a sigh of relief.
Yeah, you do, really, for sure. Chris Simon here is, praising PNB. He's saying PNB has done a good work by assenting to Banks and Other Financial Institutions Act, or a bill, 2020, that's making it an act. The bill, the act will stabilize banking operations and prevent reckless driving, rather recklessness, reckless giving of loans, that is, to customers.
Okay, Gbadamosi Haruna Damu, appreciating the bill, says what matters most is the execution of the laws, as the banking system is more or less like a public enterprise.
Jibril Sali Sunaina says banks truly need to be recovered, and then loans have to be given from debtors. And of course, as it's among reasons making some banks refusing to borrow to adequate number of people, or even leading them to near collapse. People will no longer be rich with loans for free, and thanks to PNB for assenting to the bill.
All right, Usman Banukanto's concern is rampant cases of stealing by bank staff from customers' accounts, which he wants to be brought to an end, and also, of course, for job security for workers, and to make the sector more vibrant and legitimate, he says.
Mike Yako here says, we have witnessed bank failures in Nigeria, with depositors losing their investments. The causes of the failures are not far-fetched. Inside abuses and reckless loans without due process, and directors of those banks went scot-free. Bank is fulcrum of development of any nation. The recently signed bill on bank is a welcome development, as it will bring stability in the banking system and then restore more confidence in the system. And this will lead to massive development, and investors will flood.
Okay, Danladi Ndayebo says the Credit Tribunal to improve loan recovery is perhaps the single most important merit of the Buffy Act 2020. He said this will support economic recovery and promote sustainable growth.
Titus Mondaynak says loan portfolios aren't clearly spelled, and then individuals are trapped by, petrified into accepting abnormalities. Now, the banks become a fraud when the CEO with a clean financial health bill and try to co-opt you into indebtedness by sending you tempted messages to fall into their traps.
And Uchenna Emmanuel says his concern says, my question is, why would deposit and microfinance banks lend MSMEs or SMEs rate at 29% cumulatively?
Finally, Eureka Donatus Letam says, both year 2020 is a welcome development, and then mostly in the area of credit tribunal, because the judicial bottleneck experienced in the recovery of non-performing facilities will be reduced greatly. And these are the tweets we have. Let's finally look at one or two aspects on this discussion before we round up. I'd rather go over to Professor Ango and then say, when we look at the Central Bank of Nigeria, which is expected to hold structured engagements really with stakeholders across various sectors of the economy, that is on critical aspects of Buffy Act in the coming months. What and what does this structured engagement entail in this act?
I believe what they want to do is to reach out to interested parties and probably come up with common understanding of the way forward. Now, what the central bank has done in the last few years, in my opinion, generally in response to our economic realities, is that it's actually helping a lot, because they are coming up with a lot of initiatives which are very positive, which will work in the interest of the economy. Now, having said this, I want to comment on even the future of, especially the question you put to Prop, pertaining to the realities on ground. When we are looking at the future of banking, especially this issue of automation and things like that. Now, the reality is that the future looks like there will be amalgamation of many functions. What is today traditionally banking function is being performed by many and will be performed by many other institutions. So there is those agencies, or at least in terms of agency banking we're looking at, with banking itself will look different, most probably in the next few years. And central bank, obviously, and the government is responding to these things. Right now, we have banking as we know it. What we are going to see probably in the next 10 years will be different completely. And we have to actually structure and condition ourselves properly to key in to what the future looks like. Nobody will have expected, for example, the quantum of e-transactions that are taking place now, to the extent that even during lockdown, the banking sector, the financial sector generally, had a growth, in their contribution to GDP, unlike other sectors. Even though banks were closed, the financial sector did very well. Why? Because there are openings, there are ways of doing transactions outside of hard and mortar that we know. So the future is even going to be even much more. The future of money itself is going to be something else. So we have to sit and get ready, and we have to plan to ensure we key into it. That is my take. Thank you.
All right, thank you, Professor Yushao Ango. Quickly, Professor Uchewalike, the last, just in 60 seconds. There are monetary provisions, anyone who, gets punished, gets for infractions committed. Considering the powers that these EDs and CEOs wield in the banking industry, isn't this between 20 to 50 million penalty a giveaway?
I think it has been increased now in the BOFIA. But let me touch on something quickly. This structured engagement that he mentioned, part of that will be the contentious provision, section 12, subsection 6, that talks about restorative action. If a bank license is revoked, for example, that the central bank, that the person can get, will be just monetary compensation. So I support that. It is for the central bank to ensure that the public or stakeholders, understand why that has to be so. But on the issue of penalties, yes. I think the penalties are stiffer now, than they used to be.
Okay, many thanks, Professor Uchewalike. Professor Uchewalike is President, Capital Market Academics of Nigeria. We thank you so much for being part of this program this morning.
Thank you very much.
It's a pleasure. So we extend our gratitude to Ayodeji Ebo, the senior economist and head research and strategy, Greenwich Merchant Bank. It's our pleasure you've been with us this morning. For having me. You've been a very nice contributor, and of course, Professor Ango is a professor of finance and entrepreneurship, Kaduna State University. We thank you so much for being part of this package this morning.
Thank you very much.
Just to add the use of that, Professor Uchewalike is also Chairman, Chartered Institute of Bankers of Nigeria, Abuja branch. So, gentlemen, we appreciate all of you, and also say a lot. Thank you to all of you for your tweets. And that's it for us on Good Morning Nigeria this Wednesday. Would appreciate you. Join us again, same time tomorrow, same station. I am Claire Adilabu Abdulrazak. Bye-bye.
And I'm Yusuf Nadabu Suman. Stay safe. Bye-bye.